Why do two people see the same opportunity, and only one of them becomes a millionaire? The difference isn't intellect, not education, not even capital. The difference lies in one psychological mechanism. Only one type of business person uses one psychological trick that turns ordinary deals into million-dollar results. Most sell hours of work and services. They focus on results first, and this small shift gets people to hand over the check. No magic or ties required. It's just one simple question and a different way of listening. Stay to hear the precise wording, a real-life example you can emulate, and one action you can take today to start closing bigger deals. By the end, you'll have shifted conversations from maybe to sign here, and yes, your accountant will notice. Destruction of illusions. Most entrepreneurs act on stories they enjoy rather than on facts. First notice this when first catch myself retelling a version of success that skips the slow, painful bits. It's comforting and misleading. People point to the shiny winners, those few startups that exploded, and forget the quiet majority that never made headlines. That selective view makes me overestimate how easy success is, so first build defenses against it. First call out my own wishful thinking by forcing a premortem. Before first pour time or money into a plan, first list everything that could make it fail, as if first we're writing the obituary for the project. This simple ritual turns it will work because first believe in it into what would stop it from working, and it usually produces actionable fixes. When a founder first coach insists the market will bend to their product, first ask for evidence of real customers paying, not just likes or compliments, and they often change course quickly. Sunk costs are sneaky. First have learned to stop feeding them. Instead of saying first am committed because first VE already spent a lot, first say first stop when the numbers and learning say stop. That shifts the rationale from identity to action. For example, a product line that keeps draining cash but shows no improvement in retention needs a clear exit plan. First set concrete, measurable kill criteria up front. Conversion rate below 10th for Y months, or acquisition cost above revenue per user, and first honor them. Confirmation bias shows up when first only seek flattering feedback. First fix this by making a small team member play devil's advocate every meeting. They ask the hard questions, and first reward them for being skeptical. Another tactic first use is the outside view. Comparing my plan with similar companies' typical outcomes rather than relying solely on my internal optimism. When my assumptions clash with the outside view, first revise plans or break work into experiments. Illusion of control is particularly dangerous in finance and hiring. First used to think first could predict market swings or pick perfect hires by intuition. Now, first rely on systems, processes that reduce single-person heroics. First do structured interviews, track leading indicators like user retention instead of vanity downloads, and automate stop-loss rules for investments. That way my choices are supported by data and process, not just confidence. Finally, first practice deliberate humility every quarter. First list the illusions first might be under: overconfidence, survivorship bias, the belief that this time is different, and first create one concrete action for each. Sometimes the action is embarrassingly simple. Call 3 customers, pause the launch, or run an A/B test. Humor helps too. First joke about my startup blinders, and that makes admitting errors feel less fatal. Over time, destroying these illusions doesn't make me pessimistic. It makes decisions clearer, faster, and far more likely to pay off. Promise of disclosure. Telling someone you will open the curtain on a specific, useful thing cuts through noise and gets attention fast. Marketers and coaches do this all the time. They promise the exact email template, the checklist, or the step-by-step script, and curious people sign up, click, or show up. A clear promise about what will be disclosed replaces vague hype with a concrete reason to act. It's the difference between free guide and the exact onboarding email first use with new clients. People respond because a small, framed reveal reduces risk. When first offer one clear item, a swipe file, a short checklist, a demo clip, people can imagine using it immediately. Short, usable tokens of value invite reciprocity, Someone gives an email, and first gives something that produces a quick win. That quick win builds trust far faster than grand claims about future riches. Practical example: a webinar that promises the 3 lines first used to get clients to reply will get more practical-minded signups than a webinar promising business growth secrets, because the promise is precise and usable. Make the promise specific, simple, and honest. Say exactly what will be revealed and what format it comes in. Don't say, "First we'll reveal everything." Say, "First we'll share my 1-page proposal template." Offer a tiny preview to prove you'll deliver. A single screenshot of a template, a 1-line excerpt, or a short bullet list preview eases skepticism and increases conversion. First, do this by showing a peek. 1 sentence from the script, 1 step from the checklist. People sniff out vagueness quickly. Concrete promises beat vague hype every time. Deliver fast and deliver value. If you promise a template, send the template. If you promise a behind-the-scenes clip, send the clip. Over-promising or delaying breaks the fragile trust you just built. Keep the disclosure useful on its own, even if it's only part of a broader system. For example, send the exact email subject and first paragraph instead of the whole nurture sequence. That single item can produce measurable results for someone looking for a quick fix. Humor helps. A little self-deprecation. First, we'll share the wording that embarrassed me into a sale. Makes the promise feel human and believable. Use the reveal to educate, not to manipulate. Teach one small, repeatable action the recipient can try immediately. Then invite them to learn more if they want. That's ethical and effective. Avoid grandiose words like miracle or secret sauce. They create skepticism. Instead, use statements like inside, the 3 sentences first sent to new leads, or a short checklist you can copy. Those lines sound useful and real. First, do this because simple, honest promises attract the right people and keep them. Key mechanism: revaluation of losses. People feel losses more sharply than gains. Losing a small amount stings more than finding the same amount pleases. So how we label that sting changes our next move. Revaluation of losses is a simple mental shift. Instead of treating a setback as a permanent failure, first relabel it as paid information, cheap tuition, or a controlled experiment that taught me something first can use. This reframing reduces emotional drag and frees resources for better bets. When first launch a product feature and users ignore it, first don't call it a wasted budget. First call it market research, first paid for with real customer behavior. That alone changes what first do next. First stop patching the same idea and start asking targeted questions. Which assumption failed? Which customer segment ignored it? What metric actually moved? Short answer: first extract facts and act. Longer answer: first build the next test around those facts. To make revaluation practical, first use a few repeatable techniques. First, design small experiments with fixed exposure so the pain of a single loss is minimal and useful. First, write a 3-line postmortem. What first thought would happen, what actually happened, and the one change first will make next. First, set stop rules ahead of time, not as punishment, but as a way to preserve capital and attention. First, do not nurse losers hoping they turn around. First, harvest their lessons and redeploy the savings to clearer opportunities. Language matters. Instead of saying, "first lost money," first say, "first bought experience." Instead of "first failed," first say, "first learned a boundary of what doesn't work." That subtle swap loosens the grief and sharpens action. In negotiations, losing a deal becomes a probe. First ask what price or terms are the deal breaker, then adjust offerings or qualify prospects earlier. In sales, a lost pitch becomes a script improvement session. First, don't beat myself up. First, document the why and build forward. Finally, make the process visible and routine. Create a folder labeled lessons and drop every failed test there with 1 line of insight. Run weekly reviews where the question is not who failed, but what did we learn and how will that change the next 2 decisions. Humor helps. First, keep 1 sticky note that reads "tuition paid" for small flops. It makes me less precious about being right and more obsessed with being effective, which is exactly what turns reevaluated losses into future wins. How the majority's mind works. Most people favor the familiar and the safe when choices pile up. It's a simple mental shortcut that saves energy. First, pick the brand first, renew the same subscription, and keep the same routine because it feels like maintenance, not a decision. That impulse isn't moral failure. It's efficient. Our brains treat change as extra work. So repeating what worked yesterday often wins, even if a better option exists. People look to others when they don't want to decide alone. A crowded restaurant seems tastier, and a product with many reviews looks more trustworthy. First, follow ratings, bestseller lists, and friends' recommendations because social cues reduce uncertainty. Marketers know this and highlight popularity. The trick works because human judgment leans on crowds when information is fuzzy. Loss hurts more than gain pleases, so avoiding loss drives a lot of choices. First, hold onto an underperforming investment or stay in a comfortable job because the pain of losing felt security looms larger than the promise of future upside. That instinct makes sense in everyday life. It's wiring that favors what keeps you afloat, but it also makes people risk-averse in situations that reward calculated bets. When decisions are complex, people rely on shortcuts, rules of thumb, labels, or simple signals. First, skim headlines, trust a familiar logo, and let default settings do the heavy lifting. Confirmation habits sneak in too. We pay attention to information that fits what we already believe and ignore what complicates our story. This keeps mental effort low, but it can also lock us into repeating the same errors. Too many options drain willpower and increase procrastination. Faced with dozens of plans, menus, or gadgets, first put off choosing and stick with the status quo. Short-term rewards win more easily than long-term benefits. Impulse purchases outcompete slow-growing investments. At the same time, scarcity cues and deadlines trigger quick action, which is why limited-time offers move people. These predictable patterns reveal how most minds operate: consistent, cautious, and social. And they explain both safe choices and missed opportunities without finger-pointing. What does the 1% of do? Leverage is the filter they use on every choice. They buy or create things that keep earning even when they are not working. First, build products, not invoices, subscription services, licensing deals, equity in scalable businesses, rental properties with reliable tenants. These are the kinds of assets that turn time into income. For example, a software product that charges monthly can grow revenue without a proportional increase in hours. Similarly, a licensing agreement on a single design can pay royalties for years. Simple math, repeated often, wins more than frantic busyness. First, do the thinking most people skip. Instead of responding to the immediate problem, first ask what problem this problem creates next. That mindset stops me from chasing distractions. When considering a partnership, first ask how many extra people it will take, what the customer churn will look like, and what a small failure would cost. Short answers come fast, but the deeper consequences get examined. In practice, this looks like calculating customer acquisition cost versus lifetime value before scaling marketing and refusing deals that feel good but destroy unit economics. Systems save time and scale results. First, create standard operating procedures, checklists, and automated workflows so that a task becomes repeatable by someone else. Delegation is not guilt. It is the point. For example, instead of answering basic customer questions myself, first train a support team with scripts and metrics, and then use dashboards to watch trends. That frees me to focus on higher impact moves, product improvements, strategic hires, or negotiating distribution deals. It also makes the business less dependent on any single person's mood. First, manage risk with optionality and small, asymmetric bets. First, don't bet everything on a single hope. Instead, first keep a portfolio of bets where the downside is limited and the upside can be large. First, protect myself with contracts, clear terms, and by keeping cash cushions. Networking is deliberate, not social media theater. First, meet people who can introduce distribution, talent, or capital, and first return value before asking for it. Finally, patience is a practiced habit. First, compound small wins and prune bad ideas quickly. Humor helps. First, often tell people first outsource my panic, but the result is real, steady, repeatable progress built on systems, leverage, and clear-headed choices. Psychological trick. Successful entrepreneurs turn who they want to be into what they actually do, and that shift from identity to action is the real lever behind the trick. People rarely change because they tell themselves a new label. They change when they take tiny, repeatable actions that force the mind to reframe. Saying, first write a short update every morning is more powerful than saying, first am the kind of person who communicates well. One is a rule, the other is a wish. The mechanism is straightforward and low-tech. When you commit out loud or create a tiny ritual, your brain wants your choices to make sense. If you decide, first do a weekly revenue check every Friday, then skipping that check creates discomfort, and you're nudged back toward the behavior that eliminates the tension. That nudge is what moves decisions from abstract intentions into predictable habits that shape deals, hiring, and negotiations without constant willpower. Make the habit concrete and public whenever possible. A founder who posts a short weekly product update to customers and teammates builds credibility because the action creates expectations. A salesperson who uses a fixed rule, call 3 prospects before lunch, quickly gains momentum because the routine removes the daily debate. Small constraints like these are the commitment devices that stop you from zigzagging. They turn messy choices into a pattern others can rely on. Design easy triggers and tiny rewards. Tie a cue to the action, calendar alerts, an accountability partner, or putting a stack of unsent invoices on your desk so you have to process one before leaving. Keep the reward obvious. Satisfaction, fewer follow-ups, a clearer inbox. The reward doesn't have to be big. The point is repetition. Over time, those micro behaviors change what you consider normal, and your network starts noticing the difference. Rewording your inner script helps too. Replace first am not good at delegating with first delegate the first repetitive task first hire for. Replace first don't have time with first block 1 hour for priorities each week. Language shapes action. When you say first do, your calendar and inbox will eventually agree with you. Practical rules help avoid paralysis. Pick one identity to adopt this month. Someone who negotiates, or someone who invests in their product, or someone who delegates routine work, and create 3 specific actions that express that identity. Remove friction points and make the actions tiny at first. That way the behavior survives a busy day and eventually becomes the default. This trick is less about mind tricks and more about design choices. Structure your environment so that doing the millionaire move is the easier option, and the rest follows. Keep it simple, laugh at the small missteps, and keep doing the tiny things that change the story you tell yourself into the reality you live. Why most people never learn. People often stop learning because comfort wins over curiosity. First, choose easy routines that feel safe, even when those routines hide clear signals to change. A store owner notices foot traffic dropping, but first tell myself it's just bad weather instead of testing a new window display. A founder hears customers ask for simpler features, but first explain their complaint away as noise. Those small, everyday choices of staying put add up into a stubborn resistance to real lessons. Another reason is the habit of looking for proof that we're right. First, look for stories and numbers that confirm my plan and ignore the ones that don't, a quirk many call confirmation bias. Plainly, it's the tendency to prefer tidy stories over messy truth. In practice, this looks like reusing the same sales pitch after months of poor results because it worked before, or keeping a product roadmap intact despite repeated customer rejections. It's not heroic stubbornness. It's selective listening. Fear of loss sneaks in, too, and it speaks louder than potential gain. First, hold onto investments of time, money, or ego because admitting they were wrong feels like waste. This is the sunk cost problem in action. A leader might keep funding a failing project because of the budget already spent, not because new evidence supports continuation. That choice keeps learning frozen. Admitting the mistake would teach more than covering it up ever could. Short-term pain leads to long-term lessons, but we often pick the immediate comfort of avoiding pain. Then there's the absence of useful feedback in practice. First, practice what's easy, not what's effective. Real improvement needs targeted practice with honest feedback. Trying the same thing repeatedly without adjusting is not practice, it's repetition. Salespeople who rarely get coached will repeat ineffective tactics. Teams without postmortems repeat the same missteps. Creating a habit of small, measurable experiments and reviewing results changes that pattern, but requires discipline and a willingness to fail forward. Social pressure and identity matter more than people admit. First, act in ways that keep me part of a group. So first, avoid admitting ignorance in front of peers. Entrepreneurs mimic the stories they admire rather than testing which parts fit their own business. Learning slows when image matters more than truth. First, make it safe to be wrong and curious to those around me. Learning spreads faster than clever tricks. Finally, vague goals produce vague change. First, set broad hopes like get better, rather than specific, testable steps like call 5 customers and ask what feature they drop first. Ambiguity leaves room for excuses and preserves the status quo. Clear experiments, precise questions, and small adjustments create a reliable path to insight. Without them, people loop in friendly illusions instead of extracting real lessons. Humor helps here. Admit that first am sometimes delightfully lazy, and then do the exact small thing that forces real feedback. Hard conclusion. People decide faster than we think, often within a glance, and that first piece of information becomes the yardstick for everything that follows. First, take advantage of that by setting a clear, honest starting point, a reference that makes subsequent choices easier for clients. When the initial signal is strong and truthful, confusion drops and decisions happen more quickly. This isn't magic. It's simple human wiring applied with intention. Presenting options in a clean order is one of the simplest moves first use. First, show the top-tier offering first to establish value, then the middle option as the practical choice, and a basic option last for those who want minimal commitment. The middle one usually becomes the practical buy. Short pause. People like to avoid extremes, so they pick the sensible path. First, make the differences obvious and useful, clients feel smart, not sold to. Consistency matters even more than clever framing. First, ask for small, initial commitments, like a brief call or a token deposit, and then follow through with measurable steps. Small yes lead to bigger yes, because people like to be consistent with their past actions. First, track 1 or 2 clear metrics and adjust based on what those numbers tell me. Simple habits add up. Patient repetition turns modest advantages into real gains. Ethics is the guardrail. First, use framing to clarify choices, never to confuse people. When first present options, first explain trade-offs plainly and walk away from tactics that feel slimy. That honesty builds trust and repeat business. Laugh if you want, but selling something people actually need is the fastest path to being paid again. Quick recap. Ask for a tiny yes first, quickly provide clear value, and then scale that tiny trust into larger commitments. Do this by offering something simple, proving it works, and then confidently ask for the next step. No smokescreens, just small steps that add up to big benefits. You're not broke if you miss this trick. Most people never learn how small actions change decisions. Do small things purposefully first, and you can too. Pick one tiny offer to test this week. Make it irresistible and keep acting like you care because you do. If this worked for you, do one small thing right now. Write in the comments one tiny action you'll take today. Like the video if it helped. Subscribe if you want precise scenarios and real-world use cases. And hit the bell so you don't miss the next video. No cloak required, just a little push and a sequence of actions.